there's one thing that I think the 2 billion people that want to join the middle class won't be needing is Bitcoin. As Tom said, I'm the Chief Market Strategist of the World Gold Council. I've been there for about 18 months. I've been in gold for more than 30 years, unfortunately, which is quite a sobering thought when you think about it. I'm not a Bitcoin expert. So when I express my skepticism regarding Bitcoin, this is of somebody that is a gold market expert rather than a cryptocurrency expert or a Bitcoin expert. But I'll try and explain why the two assets are very different, why I'm skeptical about Bitcoin, why blockchain is interesting, but isn't actually delivering as much as you would expect. So let's kick this off. I hope you'll be able to read all these slides. Some of the wording is a bit small. We started to pay a lot of attention to Bitcoin and cryptocurrencies, probably like everybody else, around last year, second half of last year. There are a couple of statements I've pulled off here. One from Mohammed Al-Arian, who's the Chief Economic Advisor to PIMCO, one of the biggest investors in the world. And he writes quite often in the Financial Times, Wall Street Journal, etc. And he made this comment probably about September last year. You know, if you're in gold, you've had a great year, or good year rather, up about 15%, but not really as good as you should have had. It's not a substitute for gold, but don't underestimate when a small, loyal customer base falls in love with another asset class. And of course, he's talking about cryptocurrencies. Another one I pulled out was Jamie Dimon's comment, they're a fraud, won't end well. Of course, he then pulled back from that statement later on, but certainly he is skeptical of this along with a number of other people. So let's think about what a currency is. A currency has three properties, basically. The unit of account needs to be a transaction token and needs to be a store of value. Now, if you think about cryptocurrencies, as I'll show, they're too volatile to be a unit of account. The transaction capacity of the Bitcoin network, it depends who you listen to, it's maybe 3 or 7 or 10 transactions per second in capacity, compared with 10,000 per second for the Visa network. In terms of a store of value, again, it's too volatile and too risky. So this is one way of looking at the volatility, and that's to look at the way the prices have increased in Bitcoin. I didn't go back to the beginning. Zero, which is what it looks like on this chart, has been around for a long time, but it's about 10 years old now since the original paper was written. We peaked $17,000, $18,000 a unit, and since then have fallen, broke down through $6,000 on Sunday, currently hovering around that level now. And on this scale, gold looks like the most stable asset that you can ever come across. Another way of looking at it is to actually calculate the historic volatility. This is 30-day volatility of Bitcoin since the beginning of 2016, and gold over a similar period. You can see gold is a 10 to 20 vol instrument in the 1 month tenor. Bitcoin, anything from 20 to 200 or 160. It's now declined in volatility as the markets come off the top, trading around 60 vol. That's about as volatile as nat gas or nickel get when they are really exploding. So it's now calmed down to the extent that it is only as volatile as the most volatile of commodities when they're having a bad time. Other characteristics here, and I'm afraid this screen in front of me is too small, so I'm going to have to rely on my trusty iPhone. So, running through a few of these. There are certainly some similarities between Bitcoin particularly and gold, not so much the other cryptocurrencies. In a way, Bitcoin's been designed to look a bit like gold. Supply is growing at about 4% per annum at the moment, and eventually will top out at 20 million Bitcoins sometime in the 2100s, whereas gold supply is growing by about 1.3, 1.4% per annum. Is it a historic store of value? Well, gold's been around between 5,000 and 7,000 years. People have valued it for various things. It's been part of the monetary system for a while. Even when it's not, it's an asset that people like to invest in. Whereas we've got a very short history of cryptocurrencies. They're very volatile. And there's an undeveloped product suite, and I'll talk about that in a minute. Are they independent of governments? Yes. Gold is not issued by a government. It's not backed by a government. Similarly with cryptocurrencies. Are they secure? Well, gold's pretty secure as long as you look after it properly. It's a physical asset, it can be stolen. What about cryptocurrencies? Are they secure? Well, it's true, the Bitcoin blockchain has never been hacked, but certainly the exchanges of which that many people hold their cryptocurrencies on are getting hacked at probably the rate of about once or twice a month. Volatility we've spoken about. Gold's about as volatile as a volatile G7 currency. Bitcoin's probably 10 times that. Transaction costs. You can trade gold in the wholesale market for 1 or 2 basis points. In the case of Bitcoin, can be very high. Approved and regulated. Gold is approved or regulated or tolerated by governments in pretty much every market, whereas Bitcoin is looked upon with suspicion by regulators, I think it's fair to say. The product suite, well, in gold, you can trade spot, forward, options, futures. You can lend it, you can rehypothecate it, you can do lots of things with it. Bitcoin is cash Bitcoin plus a cash-settled future on it as well. What about the underlying use? Well, gold, 50 to 90% of gold demand over the last 30 years has gone into either industrial or jewelry applications, so real applications, and with investment being something between 10 and 30, 40% at its peak probably. In terms of underlying use, there's a limited transaction usage for Bitcoin. In fact, the number of retailers that take Bitcoin for payment have declined. Even some of the Bitcoin conferences have stopped taking Bitcoin because it's so volatile. Is there a speculative market present in these? Well, it's an element of the gold market, probably drives the short-term prices, but there is this big fundamental usage and investment usage too, whereas the vast majority of the Bitcoin market is speculative. There is institutional investment in gold, growing, I would add as well, very much limited in Bitcoin. And finally, official sector ownership, very much so in gold, unknown in Bitcoin and cryptocurrencies, but likely limited. There's also an inherent paradox about a distributed public ledger blockchain. If this is going to gain adoption, then this thing needs to be quick, scalable, you need to do thousands of transactions a second, and it needs to be low cost. I mean, some of these cryptocurrencies have been said that they're going to be behind the Internet of Things, things being probably everything in this room. That chair will know when it's been sat upon, will know when it needs replacing or cleaning. This microphone will tell me when the battery's low. You can imagine how many transactions are going to be required to power that, but if you can only trade 3 or 4 or 7 per second and be unscalable, that's a problem. The reason it's a problem is for a distributed public ledger blockchain to remain secure, it's got to be expensive, restrictive, and I've said expensive twice, so it must be very expensive, for the confirmations. And I think the reason for that is very simple. For blockchain to be unhackable, it's got to be really, really expensive and difficult to make fraudulent payments or double payments, etc. on there. So although there's other things that have come along, like Lightning, which is a protocol which is supposed to overlay on top of the Bitcoin to make it faster and hold more capacity, in the end, for the blockchain to be as secure as it is, it's got to be really hard, really slow, really expensive to actually do these confirmations, and therefore it's going to restrict things. Even if it was functional, even if we all wanted blockchain, even if we were using blockchain, we could trade it rapidly, we could use it to buy things wherever we wanted, where would you trade blockchain? Because at the moment, if you look at the trading venues, the so-called cryptocurrency exchanges, there's not a single one that is AML, KYC compliant. They call themselves exchanges, they're not exchanges. They're online digital platforms that are increasingly gaining or garnering the attention of regulators. So as the one thing that is slightly different, we have within the CME, the futures market, we've got a cash-settled future. But even that's slightly dangerous because now that we have a product trading on a regulated US venue, okay, it's only cash-settled, so you're observing the price rather than actually participating in that market. As soon as you're on that regulated US venue, then the regulators are saying, well, we're a bit uncertain about where you're getting your prices from. These online exchanges or online digital platforms, are they trading properly or are they being spoofed? Are they being messed around with? Are they all the bad things that happen in exchanges that the governments and the regulators have tried to crack down upon continue to happen on these online platforms? The other thing about the exchanges, as I say, or the online platforms, they're unregulated, unpoliced, online digital marketplaces. They're regularly hacked. And as I mentioned, increasingly coming under scrutiny from regulators. So one of the reasons we started looking at Bitcoin more closely last year was because we were hearing a lot of concern from people that it was undermining gold. So I've done quite a lot of analysis looking at open interest, volumes, et cetera. That period we saw in the fourth quarter of last year into the first quarter of this year, when the Bitcoins went mad, everyone was really excited about them, both on the way up and on the way down. There's no evidence looking at trading volumes or open interest on any of the big markets, so COMEX, the LME Precious, ETFs, markets in the States and elsewhere, Shanghai Gold Exchange, et cetera. So no sign that when the explosion in interest in Bitcoin took place, we saw a diminishing in the activity in gold. One area in the gold market that has been very disappointing in the last 12 months or so, 9-12 months, has been the coin and bar market in the United States. My natural assumption when I saw the fall off in volume, they were down about 50% last year, was that cryptocurrencies were taking some of this interest away. So we conducted some personal market research. We're close to many of the wholesale dealers in the States. Phoned them up, had a chat with them, see what they thought was going on. It wasn't the first, nor the second, nor the third most important factor in the decline in their volumes. The strength of the US equity market, the real estate market, the whole feel-good factor about the Make America Great from the President of the United States had detracted from the feeling of need to buy gold in the US last year. Cryptocurrencies was mentioned once or twice in the conversations, but it was very much towards the end, certainly in terms of purchasing gold itself. I think what Bitcoin did do, it stole some of the oxygen of publicity towards gold and other assets. Particularly, I think might have had an impact on the ability of junior mining equities in Canada to raise money. Although I would also argue that cannabis stocks may have played a role there. That may seem a joke, but in Canada, this has been a really big story, and the cannabis equity market is apparently a great place to be. We're quite relaxed. Here's a chart showing what I mean by the oxygen of publicity. Google Trends is quite a nice little toy that Google has launched, and it allows you to look for searches of certain things. So looking for gold, looking for Bitcoin, looking for cryptocurrencies on the Google network, you can see how this really exploded from about the middle of last year and briefly surmounted gold, but then has quickly fallen back again. I haven't updated this chart in this presentation deck, but I have got the data back in the office, and that diminution of interest continues. And it works as well whether you put in buy Bitcoin or buy gold or buy cryptocurrency, shows a very similar trend. Final point on blockchain. I'm a skeptic on Bitcoin, if you hadn't noticed. I do notice that blockchain has potentially more interesting attributes than Bitcoin itself. And there seems to be a lot of conceptual applications of blockchain. What I would say, though, in 10 years since the start of this cryptocurrency revolution, there seems to be very few genuine applications. 10 years after the internet was launched, we were kind of using it. It wasn't as functional as it is today, but we were using it. We were aware of genuine things you could do with it. In terms of the blockchain, it doesn't seem to be doing an awful lot, and none of the things that are out there are exactly world-changing. There are 140 gold-linked or gold-associated crypto tokens, according to Ross Norman, who's been tracking these things. None of them seem to be so far the killer app. We at the World Gold Council are monitoring this space. We were behind the development of the gold-backed ETFs. So we're having a look at the potential for gold-backed crypto tokens to see whether there's a role for us to get into this market. But there seems to be lots out there at the moment, so no need for us to particularly get involved. There is the potential, I think, for gold to improve supply chain integrity. One of the things that the buyers of gold are becoming increasingly interested in now is, where was that gold mined? Was the mine that it came from following good corporate social responsibility principles, etc.? Was the gold that I'm buying for my wife for the wedding ring, conflict minerals or mined by children in the DRC? So there is the potential for for the blockchain to help improve the supply chain integrity, both before the refining process and then after the fabrication of bars. But that's probably likely to be through a private rather than a public blockchain. And if you think about it, a private blockchain, which doesn't have the distributed ledger capabilities like the Bitcoin blockchain does, a private blockchain is actually very close to being a secure database. So maybe you don't actually need the blockchain to do these sorts of things, but it's certainly spurring on these thoughts and developments. And the 4 minutes I've got left, I'm just going to run through the 4 slides that we use when we're marketing gold to investors. I'll go through these quickly. More than happy to take questions, perhaps after I've spoken. All the information is available on our website as well. So what we say to institutional investors when we try to get them to buy gold, we point out a couple of things. First of all, that gold's returns are comparable to those of stocks and higher than bonds or broad commodity indices since 1971, over the last 20 years, over the last 10 years. So gold is a safe haven, but it's also a source of returns for your portfolio. It's a potent diversifier because it's uncorrelated to most assets. And in terms of that correlation works when you really need it. So if you look at what happens when the S&P 500, which I've used as a proxy for equity markets generally, when the S&P 500 is up by more than 2 standard deviations, correlation of gold to the S&P is nicely positive, which is what you want. If equities are going up, you want to go up as well. But look what happens when the S&P 500 is down by more than 2 standard deviations. That correlation goes negative. So the S&P 500 is falling, and gold is negatively correlated to equities. So that's what you want. So adding gold to a portfolio is both a source of returns, source of diversification, and more to the point, diversification when you really need it. It's also a decent-sized liquid market. I've put some asset classes up there and look at daily trading volumes. You can see dollar yen, dollar euro, and treasuries at the bottom. Yeah, they're bigger markets than gold. But gold is bigger than the S&P 500 in terms of daily turnover. Similarly, gilts, Dow Jones, German bunds, etc. So this is a market that you can transact in many different venues, in many different ways, with a reasonable amount of liquidity. So I'm going to stop there. Thank you very much. I've got, according to this, 2 minutes and 22 seconds for questions. So don't all rush at once. Thank you very much. There is a microphone coming down if anybody would like to put their hand up and ask. No? Nobody? Okay, good. You've got 2 minutes back. There we go as well. Thank you.
Thank you, John.
Cheers.